So again, thank you everyone for joining us. Feel free to utilize that chat feature. Let us know where you're joining us from. And again, Q&A feature is here. So you guys can utilize that to ask questions. We're going to be monitoring that throughout. And I just want to kick things off by just giving a little bit of a disclaimer here. So this webinar is going to be presented by Juno, who is a partner of Beta Gamma Sigma. The information shared here reflects the views and expertise of Juno and is provided for just general informational purposes only. Beta Gamma Sigma does not provide financial, legal, or tax advice and encourages members to conduct their own research and consult with qualified professionals before making any financial decisions. So I want to thank everyone for joining for this presentation on federal changes in paying for undergrad and grad school, presented by our partner Juno. This session will be a deep dive on those changes and what they look like for you as a current undergraduate or aspiring graduate student. If you're interested in learning more about Juno, you can find them on our website under the member benefits section. So it's my pleasure to introduce Eddie Chobanu. He is the undergraduate partnerships manager at Juno, with his previous experience in admissions at Yale and Williams College. Eddie combines his background in admissions with professional experience navigating financial aid, the cost of college, and student loans to deliver expert webinars and insights for families. So please join me in welcoming Eddie.
Thank you so much, Matt. Thank you to all of you who are here. I'm excited to be part of the community and to have partnered with BGS with all of you who are joining. Now, a lot of what I wanted to share today is going to be directly relevant to many who are here. So whether you are all current college students, or if you are also considering any kind of graduate programs, there are some really important changes in the federal marketplace, particularly as it relates to student loans, that are going to be important for you to know about. Now, I'm saying this having spent the last decade of my career in education, as Matt had mentioned, across various different roles. I was a former admissions officer. I also worked as a college counselor at a high school as well. So I've seen the concerns that students and families have had across the board from those conversations. And I'm also speaking on behalf of a current grad student myself. So I'm pursuing an MBA at the Kellogg School of Management. And I can share more about this when I talk a little bit about Juno at the end. I'll just share briefly a couple notes there. But when I was having to navigate the process and figuring out how to pay for my grad school, loans inevitably become part of the conversation, right? And that's how I'm financing it. I actually heard about Juno because I needed to take out loans. I was able to get a better rate through the organization than I did even through the federal government. And so that made me happy. I'm actually saving a lot. If you do the math, I'm saving tens of thousands, quite literally, based on the interest rate difference that I received, tens of thousands on the total lifetime of my loan. So that made me really, really happy. Now, again, I come from a background where I was the first in my family to go to college, and I was a low income student. So I fully recognize that college is expensive, and every amount that you can save is going to be significant over the long-term future, right? Any interest, for example, specifically like any interest savings, a small half percentage point difference, 1% difference in interest rates does add up over the course of a 10-year loan or a 15-year loan. Now, again, I'll share a little bit more about just the changes and why that might even be important to you. Just another disclaimer, Matt had covered it very excellently, but similarly, I would point you to um, certain professionals in the industry and financial advisors, tax advisors, financial planners. We do not occupy that role specifically. We are here for educational purposes to really make sure families are knowing how to navigate through this process in particular ways. And so we are not a lender directly. I'll specify that. We partner with lenders. Juno's like a union for student loans. So we are not a lender directly. But of course, we operate in the student lending space. So with that, I wanted to point you again to all the appropriate investment professionals, financial planning professionals that you may already be connected to or may want to connect to. Now, I'll give it just an overview of the changes. I'm going to focus on kind of what it looks like for parents, because I know some of you are current college students right now, and your parents may be borrowing on your behalf, or you may also be borrowing a federal direct loan if you're currently an undergraduate student. I'm going to spend some time talking about the grad process. Uh, Very briefly, I'm not really going to talk about repayment. I only left these slides in here as an overview and a reference for everyone here if you're curious about that. Really not going to spend as much time talking about the different repayment programs um, and then what some of these changes might actually mean for you and how you're navigating through the process. So again, these changes, one final disclaimer here is things can change, right? Some of these changes are going into effect. The biggest ones have gone into effect. They've been signed into law. There's still some negotiated rulemaking going on. So just as a quick caveat, this is accurate as of today. There can always be some minor changes presenting. The big stuff is settled though. So as we think about what is happening, federal changes are reducing the borrowing options for families. This change is going into effect July 1st of this summer. So anybody who's borrowing after July 1st is anyone who is a new student who is borrowing after July 1st will have restricted borrowing limits. So parents of new college students will have less access to federal aid. So if anyone here has younger siblings, maybe who is a current senior, for example, the process is actually going to be a bit different than your own process when you applied to their process as it relates to federal student loans and specifically the Parent Plus program. This is also going to be true if anyone on the call right now has not borrowed the federal direct loan. So if you have not previously borrowed through the federal government and you borrow for the first time after July 1, then you are subject to these new rules. So again, I'm not sure exactly what scenario you might be in. I'm happy to meet one-on-one with you to walk you through some considerations. But if that is also the case where you have not borrowed any federal aid up to this point during your college career, you would be classified as a new student. You would not be considered granted a legacy exception. And I'm going to get to that in a moment. So, right, it really is for parents of new college students. Graduate students will also see lower borrowing limits. So for any current undergrad now, if you are looking at grad school, the changes I'm going to discuss are going to be what is in effect. Now, for myself, like as a current grad student, again, there's differences if you're currently in grad school. If anyone is in that audience that is on the call now, you will be granted the legacy exception. We can get into that. Um, so again, there are ways depending on what your situation is and when you are beginning a program is going to significantly impact the availability of federal funds for those specific programs that you're in. Now, with these legacy provisions, sometimes called interim exceptions, sometimes known as being grandfathered in to the old terms of grandfathered in to the old terms of the loan or the loan borrowing capacities, these restrictions will not impact you. And so I just want to again make that clear. So there are going to be some big changes that are happening. I'm going to talk at length about them. But for example, the Grad Plus loan is getting eliminated entirely. And so if you have been granted the legacy exception, you could still borrow under the current limits before the changes go into effect July 1. Again, if someone is granted the legacy provision or the legacy exception, they are not subject to any of the new graduate or professional school caps. They're not subject to the new Parent Plus, which is on the undergrad side limitations, and neither the annual limitations or the annual or the neither the annual limitations or the aggregate or lifetime limitations. Now, how does this work? So first, a student has to be enrolled in a program of institution. Now, I'm going to assume everyone who's on the call here is just given the audience. But again, depending on whether you are actually a current undergraduate student or a graduate student, can certainly impact the differences in your scenarios. Um, and so you have to be enrolled in a program before July 1. So as of June 30th, the last day before these changes go into effect. You have to have had a direct loan distributed before that same period of time, right? So if you've never borrowed anything through the federal government, for example, if you haven't taken out that $5,500 loan in freshman year, then you will be considered not available for the exception. Now, additionally, you have to stay enrolled in the same program at the same institution. This has significant implications for transfer students. Now, transfer is a little bit less common on the graduate side. Of course, it certainly can still happen, but particularly on the undergrad side, right? So wherever if you may have transferred yourself, or if you're looking at it coming, or maybe a friend, a classmate of yours who may be interested in transferring, if a student transfers after July 1, then they lose any legacy provisions that they may have had, and they basically restart under the new terms of the borrowing limits. So a student has to be enrolled in the same program at the same institution, and they cannot withdraw from that program. I see a question here from Denny. You graduate from your MBA soon. Congratulations. Exciting for you. Happy. You have student loans. So you're awarded for your MBA in the summer of 26. However, you're starting a doctorate on May 4th. How does this affect me? You receive Grad Plus and Federal. Okay, great question. So there, if your program begins before July 1, then you are, and it is in fact confirmed enrollment in that program, then you will be a student before these deadlines go into effect. So the changes won't impact you. Now, the challenge where we sometimes see this is, and congratulations again, by the way, on both your doctorate and your MBA and your upcoming MBA graduation. But for your doctorate program, sometimes what we will see is if there is a gap. So if your program started later, your doctorate program started after July 1, that would be considered, it is a separate program entirely, of course, but that would be the program enrollment date would subject you to the new caps on grad school and professional school borrowing. And we'll get into what those caps are. Great question. I would strongly suggest reaching out to your financial aid office to confirm this, because there have been schools, have been hearing about some schools moving up their start date, their tuition due date, getting students on campus. It sometimes it's possible, sometimes it's not possible. It just really does depend on the program. Um, but moving the start dates up for this year to give one more class of students the opportunity to borrow under the old terms of the loan, which don't have these same caps, these same restrictions. Excellent question. Feel free to reach out to me if you have any other specific follow-ups as well. So students can keep, again, if you are granted the legacy exception, you can keep the old limits up to 3 years or until the end of your program. So for example, for any current college student, current college freshman, you would have 3 years, 3 years or the duration of the remaining program, which is also 3 years. So in that case, it'd be the same. It'd be 3 years. Now, if you are a college junior right now and you need to borrow for one more year, then you're only eligible for that one more year. You're not eligible for 3 years across the board. It's the lesser of the amounts. And so just want to make sure that everyone knows that because it's the expected time of completion of your degree, whether it's on the undergrad side or on the graduate or professional school side. So be mindful of this in terms of how much longer of a borrowing window you have, because that legacy window, again, can extend for the duration of your current program. But as we were just talking about, if you then go to enroll into a different program, so let's say you finish your undergraduate degree, you get your bachelor's degree, that's great. But if you then enroll in a master's, that is a separate program, right? And so your window will not extend into another program, into a different program, and it won't even extend into a different university, right? As we mentioned. So that's that capacity, that limit is important to know in terms of the timeframes. Now, let me talk a little bit about just a little bit about the Parent Plus changes. Again, I assume many of you may be familiar with a little bit about this process. Maybe your parents just handle it entirely, if so, that's okay. But let me walk through some quick numbers using UCLA as an example. And there's nothing not to highlight UCLA over other institutions. This is going to be a true pick any institution across the board. So if we were looking at UCLA's cost of attendance last year, um, then or this past academic year, so about $43,000 in total. From there, the total cost is meant to encapsulate all of the things that you might expect billed and sometimes unbilled expenses are also included in this. So, for example, tuition and fees are billed expenses. Food and housing, also called room and board, oftentimes, those are billed expenses by the university. Health insurance can be a billed expense, but other things are unbilled expenses like personal expenses, transportation to your school, books, some of these things that add additional cost to your college education. This is meant to be a comprehensive amount. It's the sticker price, right? Like you've all seen it on your financial aid offers or your financial aid awards if you've received financial aid. And if not, it's the sticker price number on the college's website. That is an annual cost, so it is the cost of 1 year, right? So all these things sum up to the cost of attendance. One quick note that I'll mention here is health insurance. If you don't know this, you may already, but health insurance can be waived if you are on a parent's plan and their health insurance covers you wherever you attend college. If it doesn't have sufficient coverage, then you might be forced into the school's health insurance plan. Um, from here, once we have the total cost of attendance, the maximum amount that a family is able to borrow is that number subtracting from there any other financial aid that is received. So that's what I want to get to in the subsequent slides here. So if we use this as an example, let's say a student got a $5,000 scholarship or grant from the school. UCLA doesn't offer a lot of, as many scholarships, certainly as some other private universities might. It's just tougher for public universities to do so. But let's just say a student was able to receive a scholarship, a smaller scholarship, and the family was able to contribute 5,000 from their savings to the cost of UCLA. Now you subtract that and you get the remaining amount to borrow of 10,000 less, about $33,000. Now, how can you then fill that gap? You have direct loans. So for a first year student, it's 5,500. For a second year in college, the limit is 6,500, and then sophomore year, excuse me, and then junior and senior year, it's 7,500, a maximum limit. Now, you subtract the direct loans, that would be a loan that the student takes in their name. So you may all already have this type of loan that you're responsible for. It's expected that you are, and it's not a bad loan to take out. Generally, what we recommend at Juno is that if you do have to borrow, do the direct loan first, because it usually has a more favorable interest rate. So this year it's a 6.39% interest rate, which is fairly good in the market. I mean, I know that's high, but like we're comparing it to where we are today, not where we were like pre-COVID, where interest rates were super low. So in today's market, 6.39% is actually fairly competitive in the student loan borrowing limit, borrowing student loans borrowing space. So from there, um, your direct loans are also eligible. You have federal protections as well as opportunities for public service loan forgiveness, right? So this happened a lot actually. If any of you remember this or you had older siblings or friends, like during COVID, a lot of students, student loan payments were paused. But that only applied if you had loans through the federal government. That did not apply if you had your own private loans. So though there are particular benefits to federal loans, certain protections, as well as the opportunity for any kind of forgiveness if you do enter public sector work or public service work. Now, the remaining amount then after the direct loan is usually historically families just borrowed the rest through the federal government through the Parent Plus program. So in this example, you could say if family needs about 27,700, you can get the entire amount, borrow that entire amount through the federal government. Now what's happening is that's not going to be possible anymore. So there's a limit of $20,000 per year for the Parent Plus program. So for any current undergraduate students, your parents will not be able to borrow. Again, let's just say this was your scenario, and you need 27,000. Your parents would not be able to borrow 27. You could only borrow a maximum of 20. That is the rule that's being implemented starting July 1 of this year. It is a per student cap. It is not a per parent limitation. So for you who is tuning in right now as the student, regardless of which parent borrows how much doesn't really matter. It's $20,000 annually for you as a student. Now, in aggregate, it's going to be a $65,000 lifetime limit. And so again, this is not dependent on which parent borrows. If you if you are borrowing, and I'm just going to use Denny as an example because you asked the question earlier. So Denny would, oh, actually, Denny's a grad student, so it's not applicable, but let's just pretend, Denny, you're an undergrad student. Your parents would only be able to borrow in total, doesn't matter which one, one or the other or both, a combination, would only be able to borrow $65,000 on your behalf for your undergraduate career, right? It's not 65 from one and 65 from another parent for a $130,000 combined limit. This is really important to know because this directly impacts you as a student, because this number is going to stick with you. This is the restriction, this is the limitation in the borrowing limit, whether you're aware of it or not. And this is why I hope you are all aware of this and let your classmates know, your friends know, because if your family does need to borrow more than this, they simply will not be able to. These are the new federal caps that are being implemented July 1. And so if you have a sibling also enrolled in college, that's okay. You each have your own $65,000 lifetime limit cap. Repayment of these loans does not reset the cap. So once that amount is borrowed, then that's it. Maybe a family does borrow 20,000, but then they pay off 10,000, right? So you're still capped at the remaining 45 left. Okay. I see a longer question in the Q&A here. So let me just take a moment to read it. So, accreditation manager at Goodman School of Business in Canada, interested in learning more about the benefit of our local and international students. Juno's American organization primarily. Oh, good question. So primarily, this is a question around and absolutely. So BGS is global, and it's incredible in the amount of reach and impact that the organization has had. So currently, this is an excellent question, Mohsen. Currently, there are some options for students who are studying in the U.S. Typically, there are a few very restricted number of lenders that will loan uh, to families who do not have a US-based cosigner. I'm happy to talk more extensively on this. I'll just mention a quick point. Uh, a lot of the lenders that we're partnered with, all the lenders that we're partnered with, in fact, require a US-based cosigner. Now, this does pose a challenge for international students or students who are coming from abroad and studying in the US. Believe me, this has been an ongoing conversation well before I joined the Juno team last year. Um, the Juno team has been trying to expand eligibility criteria for international students, and there's just been a lot of pushback from lenders in terms of the risk tolerance profile of what that means and what that looks like. Now, it's a little bit different it can be a little bit different on the grad side, um, depending on program type. But that's a little bit of more of a nuanced conversation um, than the format here. Students will still, international students who are studying in the US will still need a US-based cosigner, unfortunately. We will continue to push to expand eligibility criteria. There hasn't been a lot of reception, unfortunately, from the lenders or the banks that we have these conversations with to change that. And I'll say there are still options to borrow as an international student. Typically, the interest rates are high though, so it's possible, but it's not. I mean, it's financially just more expensive, unfortunately. Great question. Please keep the questions coming. I will keep my eye on the Q&A. You're welcome to save them towards the end, but you can post them throughout. So let me just run through this just in the interest of time because I do want to make sure we get to some of the grad side and then leave plenty of time for your questions. But I wanted to show, again, just another example. Let's go back to UCLA and see how this plays out. So we have that total cost of attendance of about 43,000 that we mentioned. We subtract this the 10,000 savings and scholarships, right? So we can see that if a parent does borrow the $20,000 in that first year, there's still an unmet need. There's still a gap here of about $7,000, $7,700, right? So the family has to figure out how to pay for that somehow. You have to come up with the funding. And so from there, how do most families fill that? Typically, it's taking out additional loans. Now, again, it could excuse me, it could include maybe dipping a little bit deeper into savings. There are things that like student could have a campus job, for example. Maybe parents are picking up extra shifts at work or working overtime, right? I'm not making any kind of value judgment on what a family should or shouldn't do. I'm just explaining some of the ways in which families might make this decision to help fill this gap. A very common reason to fill this gap is to take out additional loans to meet that gap. Now, what happens if we fast forward or zoom out over the course of 4 years now, right? Not just the first year, but when we look at how the federal impact on the undergrad side significantly contributes to more unmet need. This is the problem and the dilemma that I'm trying to make sure that all families are understanding. So when you think about the unmet need for year 2 and year 3 will go down because the student can then borrow more through the direct loan. So I mentioned earlier that it's 5,500 freshman year of college, 6,500 sophomore year, and then 7,500 junior and senior year. And you see those numbers reflected here in the total borrowing limits. So once that's accommodated for, then what do we do from there? The unmet need goes down by 1,000 each year because the student can borrow 1,000 more. Now, what's critically important is paying attention to year 4 or senior year of college. Now, a parent will have borrowed $60,000 up to that point, 20,000 over the 20,000 annual limit over the course of 3 years. Now, with an aggregate limit of 65, you only have parents will only have $5,000 remaining. So you can see how the gap explodes to $20,000, almost $21,000. Now, this is really important to know because I have talked with families this year, over the past couple of weeks, and especially last year, where this was very true last year, where families would say, again, they want to support their children going off to college. It is an incredible amount of work that you as the students have put in to get to this point, right? And so parents want to make your dreams a reality. And many of them, some, I should say, some that I've spoken with, many that I've spoken with have said, hey, we will figure it out. We're gonna make sure that, I'm gonna make sure that my child can get to their dream university and have a fulfilling experience. Now, that's really admirable, and I respect parents so much for doing that. What I want you all to realize and to be aware of is that that approach should be more should have a level of caution that just is not really possible to be as unprepared as that anymore. And what I mean by that is because when you get to senior year, then just suddenly you're already borrowing, right? You've already borrowed 60,000 up to this point. And then there's this unmet need that you're going to have to fill somehow, typically through the private loan market. And then you want to know what rates you may qualify for in the private loan market to see, first of all, could you get better rates than the Parent Plus? If so, that's a good sign. You're welcome to go the private loan market instead of the federal anyways. But if you don't see better rates through the private loan market and you have to borrow $20,719 at a 12% interest rate, I strongly encourage you to have an idea of that early on before you're forced into that decision and before seniors in college, many of whom, some I know here are either juniors or seniors. You don't want to be in that position and then be not know where that final year of funding is going to come from, or be particularly strained in that final year of funding. And I just want to emphasize that again, because our goal and sort of a lot of what I want to communicate with students and families, and whether you're an undergrad or grad, is you have to have a thoughtful plan now more than ever with these changes that are coming, because it is not possible to be flippant anymore about we'll just figure out a way to pay for it. You may figure out a way to pay for it, but it can cost you a lot more as a result. And so these conversations have to happen at the beginning where students are going, like thinking about what school they're going to enroll as seniors in high school, right? Where they're going to go to college so that you can have this 4-year plan throughout college. And then certainly if there's any grad school conversations along the way, then to plan for grad school on top of that. And so let me just go through a couple more of these as well. Still keep my eye on the Q&A here. Um, but if a student does change majors, and that is okay, you can keep your legacy status. So students, especially in undergrad, will change their majors multiple times. That's fine because you're still enrolled in a bachelor's program, whether it's Bachelor of Arts, Bachelor of Science. The program type hasn't changed, right? And this is different if you do a master's. That's a different program. So as long as you are still in the same program at the same university, that should be fine. Now, this is also true again. I remember hearing this from financial officers who are looking into this as well. This was a big question of if you're in an engineering program and you drop out, for example, you go from engineering like a Bachelor of Science to a Bachelor of Arts, and you become, let's just say, a philosophy major. That should be fine as well. So you wouldn't lose eligibility in that regard. Because again, fundamentally, the program is still a bachelor's degree at its core. Now, what's really important and what we emphasize is that if a student transfers, then you will lose legacy status. So if you're a current junior or sophomore even, and you want to go somewhere else, then this may or may not be important for you, depends on if you need to borrow federal loans. But if you do need to borrow federal loans, then you have to borrow under the new restrictions. Now, it could be okay because, if you only have 2 more years, or 1 more year, and your aggregate limit is 65, that's fine. But keep in mind, you still have an annual limit of 20,000. So in that regard, it can still impact a student and a family. Just be really careful with any withdrawals. I know students need to take time off for a variety of different reasons, and that's okay. I mention this just as like dotting all your I's and crossing all your T's to double check all of the paperwork in the case that a student does need to take a leave of absence. So I don't want current college students, for example, if you choose to take some time away from school, make sure it's documented appropriately as a leave of absence and that you are not withdrawn from the university. Because if you withdraw officially, or if you are withdrawn from the university, then you will lose eligibility and you have to then borrow under the new terms. Again, I hope this is not important for anybody, but again, I also recognize that like students will need to take time off for many different reasons. So you just want to double check, make sure you're working closely with your financial office to showcase that it is a leave of absence, it is appropriately documented, and you work with them so that they are not withdrawing you from the university, but that there's an intention for you to return. Okay, we covered a lot, and I want to get to a little bit about the grad side as well. So again, just to summarize, ensure that you're enrolled in a program before June 30th, having taken at least one federal loan out before July 1, being in the same program, and then if needed, again, working with your financial office to get an appropriate leave of absence documentation. Um, Anyone after that for Parent Plus specifically, then again, but the restrictions are going to be different, and families may actually need to look into private loan options because they may not have any other borrowing choices. Okay, so as we get into some of the grad side, um, I referenced this a little bit. Typically, and this is true for me, and I know we may have some other grad students who are here right now. Grad students usually had access to two different loan programs, the direct unsubsidized program and the Grad Plus program. Now, Grad Plus starting next year is getting cut entirely. So I'm not even going to be able to look at Grad Plus because it's not going to exist anymore. And so the program that now exists is the direct unsubsidized for students. It depends on what program you are in, and I should say specifically the classification of your program, whether it is a master's degree or a professional degree. And so for professional degrees, those have higher borrowing limits of 50,000 through the direct unsubsidized program. But any other program, master's program, grad program outside of that will have a 20,500 borrowing limit. Now, these are some of the professional degree programs. This is something that can still change. There's conversation around what is classified as, and I believe there's a couple lawsuits around which programs are classified as professional degree, because obviously this has big implications on borrowing capacity. So here you can see the difference between the borrowing capacities of what is just considered a graduate or a master's program versus a professional program. So graduate students have an annual limit of 20,500 and a total lifetime limit, an aggregate limit of $100,000. So this is most master's programs. Now, professional students have higher borrowing limits. Like we highlighted that 50,000 annual limit and a $200,000 aggregate limit. Now, again, this is double the aggregate limit. This is very important for whether or not a program is classified as professional versus graduate can have huge implications on students' availability of funds to enroll in that program, which is why there's a lot of conversation still ongoing about some particular programs that are trying to be classified as professional programs. So some of these do include programs like medicine, law, dentistry, pharmacy, vet, optometry, podiatry, chiropractic care, osteopathic care, clinical psychology, and theology. This list may change and it may expand. So again, as of today, be mindful of that, but there can always be some changes to these programs that we have to keep an eye out for. On the grad side, the loan limits are structurally not enough. They are insufficient for many programs. And so what you see here on this chart is the borrowing cap of many of these different programs, professional programs that we are highlighting, and the funding gap per year. So if you can borrow up to only 50,000, these are professional programs. If you can only borrow up to $50,000, then structurally you need more, right? So for pharmacy, you're going to need closer to 75 per year. There's already a $25,000 gap there. Dentistry is the most expensive, right? So you actually will have a built-in gap of about $75,000 that you have to find funding for out through other sources because the federal sources are no longer going to be an option. And so this does have really big implications, important implications, especially the type of program you enroll in, how expensive your program is. And understandably, like some of these programs, they're expensive because there's a high ROI to them, right? But also know that depending on your circumstances and your situation, and even your own credit score or income or things like that, then that can impact how expensive this degree actually becomes. Because I mentioned earlier, right? Like, let's say you do have to borrow. Uh, well, I'll use dentistry because it's going to be the most intense example in this case, as you can see from the graph. Let's say you have to borrow $50,000 at the 8.94% Grad Plus rate. The federal rate is 8.94% this year, and so that's going to be an expensive loan in itself. And then there's another $75,000 on top of that. If you have maybe if you have good credit scores, or if you have an income. Most students don't have an income while they're in college, obviously, but you might have a household income. Some students are married, for example. There's a whole range of circumstances that may apply here. Let's say you might see a rate that is either better or worse. If it's worse than what you're already getting, you're going to pay, that degree is going to be even more expensive than what it would have been last year because of these changes. So want to make sure that everyone is aware of these so that if you are structurally forced into the private loan market because you cannot borrow through the federal government anymore, then at least know what you're up against and you know what your options are. I just see a question. Yes, the slides will be available. So we like, and I want to spend a quick moment here because like one of the things that we care a lot about at Juno is just getting this information out there. So we don't gatekeep information. Like all of our presentations are on our website. You can find them. All of our slide decks we make available to all of our partners. Um, our goal is if you are in this situation or you know somebody in this situation, like it is that responsibility to pass it on, right? Like if you have friends who are also applying to grad school alongside with you, I know there's a lot of seniors, college seniors in the audience here, right? So like if you know and you're already planning, you probably have already received your decisions by this point. You may know where you're going. Let them know because the worst thing that can happen is a student goes into this process unprepared, right? And so pass it on, pass this information on. We will share the slide deck broadly. Everyone is welcome to access it. Please make sure you do refer back to it. Again, with that caveat, like it's a snapshot in time. So, things can certainly change over the coming months, but just want to make sure that we emphasize that. Now, students do have to be enrolled generally in full-time programs. So if a student is enrolled in less than full-time programs, there can be prorated rates at which they have borrowing capacity. Um, this is a slight question. I want to be mindful of time here. So some dual degree programs can affect borrowing limits as well. So I'm in an MBA program, for example. I have classmates who are at my school who are in a JD MBA program. So they're actually doing both. And so law is actually considered a professional degree, but MBA is considered a graduate degree. So, right, that does have implications for borrowing limits. During the MBA part of the education, there's set borrowing limits. During the law side or of the degree, there are different borrowing limits for that. So there are sort of opportunities to have different borrowing limits based on the program that a student is in. And then sort of in summary as well, again, you have to be enrolled to preserve the grad legacy status. So these changes will not affect students if they're enrolled already before June 30th in a grad program. If you've taken out a loan through the government in the past before July 1, again, you have to be enrolled in the same program and you have to complete your degree within the expected time to credentialing. For anyone who's looking at grad, maybe again, college seniors right now, even college juniors, assume that you will not actually have the grad plus option. It's disappearing. It's not going to be available. So you need to budget under that 20,500 unsubsidized loan limit. And then anything beyond that, and unfortunately, many graduate programs, I'll say safely, many graduate programs are more than 20,500 per year. So there's likely going to be some kind of gap that you'll face. Know whether your program is considered graduate or professional, because those do have different borrowing limits. And then you may actually need to plan for private loans to fill the gap. Again, this is going to be more a reference slide. It's on repayment plans. I'm not going to talk about this really. I want to just really spend more of our time on Q&A. But just know that there's a new standard repayment plan and also repayment assistance plan. Many repayment plans that currently exist are being consolidated or being sunsetted. And so there are, depending on the loan balance, will determine your repayment terms. And then also depending on your income you can see in the charts here, that will dictate the percentage of your adjusted gross income that you're then going to be expected to contribute. And so here's just one more reference slide where you can see the payment schedule by income. Now, a few final thoughts on how this it's the OBB is the One Big Beautiful Bill Act. This is what was passed last year that has included all of these changes. Many other provisions as well, but big changes on the student loan provision side. Now, I did see this, and I see this question right now, so this is a great segue to this. Um, Nee asked, how does the lifetime borrowing cap affect students' ability to pursue graduate education, especially for lower income students? So it does have implications, and this is kind of what I want to highlight on this slide and the next. Um, Families who are filling out the FAFSA, who are dependent on federal assistance, for example, will face additional and greater uncertainty. Families without strong credit or students on the grad side, because all graduate students are considered independent. Undergraduate students are generally dependent students. So on the grad side, what is your credit score compared to on the undergrad side? What is your parents' credit score? What are do your parents have on the undergrad side a history of stable income? Right? There's that may or may not be the case. So families that may face additional challenges throughout this process are going to be the families that have historically been socioeconomically disadvantaged. And that is just the really unfortunate part of what we have to face here is that if you are coming from a lower income background, I'm not saying it's not possible. Um, I'm saying this again as a student who's on who was low income going into my undergrad and borrowing a lot of money to pay for my grad program. Uh, it is it is going to be the expectation. And so, Nee, I'll address your question specifically on the grad side. It is going to be the burden of the responsibility is going to fall on the student to then pay for their own loans, right? Whether or not you have family support, I hope you have family financial support to step in and chip in to help defray some of those costs. But the burden is going to fall entirely on students on the grad side. On the undergrad side, the burden is going to fall a lot on parents, and they are going to bear the brunt of this. So families have a lot of debt. If they have several children in college at the same time and have access to less available cash to pay for, obviously paying for two children in college is more difficult than paying for one. Anyone who relies on federal protections, right, through the Parent Plus program, those are huge. But from there, even transfer students, as we mentioned, are going to be disproportionately impacted. So these are the changes. Again, there are reasons to understand why these changes are being made. There's reasons to also understand the implications and the downsides of what this is going to cause. In the past, for the Parent Plus program, the Parent Plus rate served as the ceiling, right? So this year it's 8.94%. It was the worst rate that you could get in the market, as long as you qualified. So as long as a family member didn't have an adverse credit history event on the record, most families qualified, right? So it served basically as an insurance policy where if all else fails, you always have Parent Plus as the backup, right? And this is what I was trying to emphasize earlier, like that backup plan is no longer a backup plan. So families can no longer just say, "Oh, I'm going to figure it out. Like it'll be fine." I mean, you may figure it out, but again, it's just going to probably be more expensive, depending on your circumstances. It may cost you a lot more to be unprepared. And so, as we think about, again, just in summary, um, thinking about some of the important tips, transferring colleges is going to have really big implications. You want to make sure you're emphasizing financial fit in any university, undergrad programs, graduate programs. How much is it going to cost you? These changes are happening starting July 1st. Want to make sure that students, any counseling staff that you may be working with, administrators at your schools, financial aid counselors are aware of these changes, but anyone else within your sphere of influence, parents, anyone within your sphere of influence, you want to make sure that they know about these changes so that everyone is on the same page about how you can create a strategic plan to move forward. And then again, families have always had the concern about um, return on investment. What does that mean for high school, for college, anything beyond that? I'm going to go through this really quickly. Please make sure to post your questions in the Q&A. I don't see anything currently there. I'm just going to spend very quick time sharing a little bit about Juno. I referenced this earlier. I'm a Juno member myself. That's actually how I heard about the organization. I joined the team after because I was so happy. Like genuinely, like I'm saving a lot of money because I got a much lower interest rate. And so we have we are actually over now to over 250,000 members that we've worked with and that we're actively working with. Basically, what Juno is like a union for student loans. So for all the students that do need to borrow, what we do is we bring those students together, we pull them together, and for those that do need to take out a loan, we shop as a collective. So there really is strength in numbers. We shop as a collective and go to different lenders and banks, and that's actually what we're doing right now to say, hey, we've got 20,000 Juno members in our group. What are you able to offer us? Right. So it's basically like an auction where different lenders will offer different rates and terms based on the Juno group. And then we pick the ones that are best and that best serve the membership. Juno is free, like you don't have to pay anything. We will never ask for your money. So just want to emphasize that, like the what you're signing up for, we basically ask just a couple quick questions like your name, your email, if you know what school you're going to, the type of loan, undergrad or graduate school. Um, if you have a credit score or if there's a cosigner, who that cosigner is and what their credit score might be. So a couple quick questions, and then from there, that's really most of the questions. We then aggregate that, we anonymize it, we never sell data. We anonymize that and then go to different lenders and shop around based on the creditworthiness of the collective group. And that's how we're able to get better rates and terms. So if you are interested in learning more, the link is here. And I think Matt will post it as well in the webinar chat. So feel free to check it out. Again, this is like no commitment. There's no cost. Oftentimes, and appropriately so, like, families are like, wait, what's the catch? Um, what you're signing up for is basically a mailing list to agree to be contacted once we've negotiated our rates. The more families we have, the more students we have at this point in time before April 30th. So we're kind of in our crunch time here. If you are able to sign up, that's just tremendously helpful for us and for you and for everyone in this group together. And I'll say personally for me, because I'm already signed up and I'm part of this. So it does not obligate you to take out a loan. It is not a check on your credit at all. Like I just want to be really clear about that. Um, there's no like you're not obligated to do anything just because you become a Juno member. When you become a Juno member, it's again just agreeing to be contacted when that deal is live, so we can present it as an option. You don't even have to take the deal. Like we actually encourage you to shop around, see what other lenders are offering, rather than the ones that we may have partnered with. See what other lenders are offering, and we have historically had a rate match guarantee. So even if you find a better rate elsewhere, there's a very high likelihood that we can match that same low rate, and then on top of that, give you a cashback bonus. That's one of the benefits of being a Juno member. We give a 2%, well, depending on the type of program that you're in, whether undergrad or grad. But we give a cashback bonus as just a little extra a perk. So again, I'm happy to answer any questions. If you want to reach out to me directly, you can sign up for a time to meet with me on my calendar. We host a lot of different webinars. Again, we just want to make the information accessible, available as much as possible. We're not gatekeeping anything. The more informed you are in this process, the better off you're going to be, because that means you are going to shop around. You are going to explore all your different options. And that's where like we are actually so confident in what we're doing at Juno that when you do shop around, we're fairly confident that the best deal that you're going to get is through Juno It doesn't always happen, and I can't always guarantee that obviously to happen, but we're fairly confident in a large number of cases that the best rates you're going to see are actually going to be through Juno. So check that out. Check out everything else that's on the market, because again, the more you know what is what is specific to your individual circumstance, your family circumstances, the better off you're going to be. And one last thing I'll mention, you're welcome not just to meet with me, but we have a team of folks who support students. You can find that on the last link here on the slide. Um, I'm keeping my eye on the Q&A. I'm not seeing anything come in. Happy to wait if anyone does have other additional questions.
Yeah, we can wait just a minute or two here. I know we're right at the end of our time here, but if any last minute questions come in, I'm happy to wait. I just want to thank you, Eddie, for taking some time today to talk with our members and to share all this information. And I really appreciate everything you said about making this information available to everyone. And not gatekeeping information, and that's one of the big reasons why Beta Gamma Sigma was so interested in partnering with Juno was how open and honest they were about trying to help students and trying to help our members as a result. And so just thank you.
Absolutely. It was my pleasure. Thank you all to everyone who tuned in. Again, you'll have access. Matt, I'll share the slide deck with you so
Great.
that you're welcome to pass that on to the folks here. So I just really appreciate all of you and your time and wish you well as you navigate. It's hard enough to navigate college and and grad school without all of this other stuff happening in the background. But I'm wishing you all very, very well and much success.